The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone. Thanks very much for joining us tonight. Malema threatens to shut down Joburg businesses. Twitter users speculate over Zuma's health. Eskom credit rating downgraded. These are just some of the headlines dominating the media and newspapers over the last month. And they're what's driving the politics behind your investment and your trade. That's what we have to discuss tonight. Politics and profits. How Malema's loud mouth, the weakening rand, and the South African recession could make the next 3 months your most profitable ever. Now, joining me this evening is Robbie P., your very own index trader, Simon Rosalimos from Red Hot Trader, and of course myself, Warren Jeffrey of Capital Wave Trader. So, tonight we're going to be exploring exactly what politics mean to you and how you can use it in your trading. Now, love it or hate it, politics are part of every one of our lives, especially your financial life. Whether it's government grants and subsidies, taxes, business development and labor relations, currency, all of this creates threats and opportunities. Now, as a trader, this means profit if you know where to play it. So, let's explore a bit more about what politics means to you. Politics, everyone assumes, just government. And, you know, a lot of South Africans are tired of hearing about what government has to say, and tired of all the bureaucracy and corruption and all of that. But the reality is, politics are the driving force behind our economy. And what the media portrays as happening in South Africa is what investors see. Whether it's here, offshore, all over the world, investors' connection with South Africa and South African politics is the media. And these investors are what are going to drive the moves in our market. They are the ones who are going to buy into the shares we like and hopefully allow us to buy low, let the investors flood in and drive our prices up so we can make a quick gain. And at the same time, if they don't like what they see, if they don't like what the media portrays or what our politics are putting out there, they're going to get scared off. They're going to start selling. And if they're selling, that's when we as traders are going to be looking for short opportunities. So, as a trader, you need to pay attention to what the media is saying. Not because you want to get involved in hype stories, but you want to know what investors are thinking and what investors are hearing, so that you can anticipate their moves. Now, despite all the bad news and all the bad headlines you hear, it's not all bad. In fact, sometimes even when it is bad news, it's good news for your profits. What do I mean by this? Well, over the first half of this year, the things that have really dominated our news, strikes. First platinum, now the ongoing metal workers strike. Then recession, dipping economic indicators. Will South Africa be in a recession? Are we going to be crippled by strikes? Rating downgrades. Now we've got Fitch and Moody's talking about giving us junk status. All of this is not good news for our rand. But as a trader, you don't have to get bogged down. You don't have to feel disappointed about all the bad news out there. In fact, a weak rand is actually great for some of our shares. I'm sure Robbie and Simon are going to explore a little bit on this later as well. But there's another side to this. Is if the world's expecting the worst, if we've been bombarded with strikes over the last 6 months, the world started to price that into our opportunities. So should government step in and actually take action? And should government get involved and decide they're actually going to stop unions from having too much power and being able to cripple the country? That's the good news. You're going to see some nice rebounds. Not because it's an amazing work of progress, but it's simply a case of it's not as bad as what people were expecting. So, what should you do? Now, as I say, we can't go into every political situation. There's just too much happening all the time, and it's a market that moves very quickly. But before you trade, you need to consider how the business makes money. And when I say the business, whatever you trade, if you're trading shares in, say, Kumba Iron Ore, you need to understand how Kumba makes its money. If you understand that, then you know how politics are going to affect that company. And if you know that, you can anticipate where, if it's a profit opportunity or a loss threat. And if the company's going to make money or lose money, then you know as a trader what investors are likely to do, and you know how to position yourself. And remember, like I said, you've got to consider what the market's expecting. You can't just look at, say, a results presentation and say, oh, like Amcat, for example, earnings down 96%. Now, if you just reacted on that results presentation, you'd be thinking, let's go short, let's sell this thing. You know, results are 96% loss, or not loss, but decrease in profits. But if you have a look, a week earlier, they released a trading statement. They let the market know about that. But then in the results, they also told the market some potentially good news. They told them that they're going to be selling off assets. They're going to be taking advantage of trying to free up some cash for further growth opportunities elsewhere. Now, if the market's already heard about the big loss and they've priced it into Ampat's price, then when that actual results came out, people had already expected a 96% loss in terms of, or 96% decrease in profits. What they didn't expect was the positive news that Amcat is going to free up cash so it can grow elsewhere. So pay attention to what the market's expecting, because this will allow you to interpret the politics, interpret the news better, so you can position yourself to profit. Do this and you'll be amazed at the opportunities you see. In fact, Simon and Robbie are going to talk you through a couple of opportunities that they see in the market right now and playing out over the next few months. Simon, over to you.
Good evening, ladies and gentlemen, and thanks for joining. Glad you could join us for the short time. Today I am going to be talking about the Rand and what you can do about it. But you know what, to start off, I always wanted to start off with an anecdote as always. And to be honest, I was actually on Google and I was looking for a Rand joke, and unfortunately I couldn't find one. And then I thought the Rand is a joke, so that was one of them. But then Robbie came and he told me a joke about the Rand, but I won't tell you because it's rather weak. Alright, so let's get straight into it. Good news and bad news about the South African Rand. So let's start off with the bad news. Right, the Rand is at 10.70 today, and it looks like it's going to weaken even further to 11 Rand 40. And this means that you need more rands to buy just $1. And that means there's going to be higher petrol prices, there's going to be higher inflation, the food prices are going to go through the roof, and watch this, European prices are coming to South Africa, and higher capital goods costs. Right, so looking at the weekly chart of the South African Rand, you can see that it's been strengthening from 11 Rand 40 down till around 11 Rand 30, 11 Rand 40. But it's broken out of what's called a wedge pattern. You don't need to worry about that. All you need to know is between the two black lines is that's where it's been consolidating. And it's actually broken out, and today it's sitting at 10 Rand 70. But it has built enough momentum to continue to the upside. And that is why it looks like the Rand is going to strengthen back to 11 Rand 40. Right, so you can see where I expect the Rand to go, to the top of the highest candle in early 2014. Okay, enough about the bad news. Now we can go straight onto the good news. Right, so the good news is that the price of exports costs more, which is good for resources, and this boosts profits with the resource companies. And I think you know where I'm going with this, because especially in overseas with the earnings that are brought home. Right, so when the Rand weakens, guess what? Resource stocks tend to go up. And that's why earlier, well, the last trade that I sent out with Radar Storm Trader was Anglo-American, because I'm feeling good about resources, right? But I'm not going to talk about past trades, I'm going to talk about future trades. Okay, so this is giving us great trading opportunities in the next couple of weeks. So you can see this is the resource index, which is obviously broken up into the resource stocks. And you can see that it's been doing absolutely nothing from 2009 all the way through to 2014. Okay? But now let's throw some lines in. And you can see that it's been coming down from 2008 down to 2014. But then it's broken out. Okay? What you're seeing now with the red circles, these are lower highs. You can see that it was in a downtrend, but then it broke out. And breaking out means that, as I said before, is that it's gained now momentum to continue to the upside. So the blue circle is broken out and looks like more upside is to come. In fact, I expect it, right, well let's start off with from 55 Rand 065, I expect it to go to 73,128 on the index. That is a 32.8% move, which we are going to find profitable opportunities for you. Okay?
Just a note on that slide, there's an extra one there. Sorry about that typo.
Oh, yes. No. Billiton could bank your next big profit. This is what I'm looking at now. Billiton. It's been hitting a certain resistance, which you can also think of as a ceiling level, right? From 2008 to 2013, it keeps hitting the level. And now it's been going up a support line. And you can see the low is 153.99 Rand. That's called a support line. But it has been making high lows, as you can see. Right, so now all I do is I take the difference between the resistance, which is 308 Rand and 13 cents, and I take the difference of 153.99, and you'll see that I can expect Billiton to go up to 462 Rand and 27 cents, which is a 39.69% upside to come. So, when will we get in on the action? As soon as a pattern forms on Billiton, we are going to get into that trade, no doubt, right? The trade could last around 2 to 3 months, so we can grab as much upside as possible. And how will we get in on the action? When the trading opportunity comes in, I'll send you the trade, and you're going to use the CFD on Billiton. Alright, so keep your phone close, guys, because this resource profit opportunity could come sooner than you think. And now going on to Robbie P. Go for it, Robbie.
Thanks, Timon. Thanks, Warren. And evening, guys. Thanks for taking some time out. You know, we're given the topics about how politics can turn into profit, but I'd like to take a little bit of a broader view on things because, you know, the market across the world is in a growth phase. And I think it's important that you as a new or up-and-coming investor understands how markets work and how economics and politics actually affects the way that investors think. Because we might be living in a third world country, but we're not the only ones that experience political problems and threats. So what I'd like to achieve tonight is just for you to understand what investors look for and try and get you to think the way that astute investors think. And if you get that part of this webinar right, you'll understand what exactly to look for, because not everything is a threat to an investor, and there are plenty of opportunities all over the world. So, this is a quote. I can't remember who said it, but it's quite significant. And this is how it goes. A weak currency is evidence of a weak economy, which is evidence of a weak government. Now, I don't want you to jump to the conclusion that this refers to South Africa alone, because this is an economic threat in any country in the world. And you can see that in the strength of the dollar, because their politics dictates. They have two major parties, and they bash each other every single day of the week. Okay? And if the government wasn't so highly regulated, and it's one of the least corrupt nations in the world, their currency wouldn't be as strong as it is, and it wouldn't be the dominating trade currency in the world. Okay, so this doesn't apply to South Africa alone. This applies to any other country, because the minute that status of the United States changes, their currency will weaken. Weak politics equals weak currency. Okay, so here's the education. What do foreign investors look for? Okay, they look for growth. So emerging markets are obviously emerging and they're developing, and they usually enjoy higher growth than developed markets because developed markets have very limited upside or slower growth. So developed markets normally accelerate in growth much quicker than mature markets. So for this reason, investing in emerging markets won't only diversify an investor's return, but it will add a higher expectation. Okay, that's why foreign investors like to look for emerging markets. But they look for exchange rate stability as well. So a very volatile currency, for example, does dictate a threat. And politics moves money. It moves an exchange rate. It moves your currency. The minute there's market threat or a deficit in a trade balance, for example, it will directly affect the currency. And Timon can back me up there. You know, as the forex trader, the slightest little bit of negative economic news will either strengthen or weaken a currency in relation to another. Okay. So the reason foreign investors look for exchange rate stability is because a local currency, for example, like South Africa, versus the investor's domestic currency, will lower his returns. So he has to be astute and see where the best return will be. He does not want volatility in currency exchange. Okay, then liquidity is a very important thing. It dictates where investors put their money. They have to be able to get in and out. Now there's an empty pool, which is a brilliant analogy, because direct investors in emerging markets need to be able to get their cash flows in and out when conditions change. Okay, so smaller caps, many companies in emerging markets have smaller caps than developed markets. I mean, you can't compare many of our top 40 companies to Apple, for example. The guys can get in and out, and it's very tradable. Okay, so foreign investors, sorry, just give me a second.
Sorry guys, we are having technical difficulties.
Alright, we're back. Okay, the problem with emerging markets, though, as the slide shows, is industry concentration. So while emerging economies may be as diversified as developed economies, usually the publicly listed companies are concentrated in very few sectors, like financials, technologies, and basic materials. Okay, as this slide shows. So you can see in an emerging market ETF, for example, and this is broad-based across all emerging markets, this is the pie chart. Most of them are financial. Okay, and then the slices of the pie get very smaller. So you move from technology into basic materials, and then everything else kind of just becomes less and less. And that is a concern for a foreign investor, because they are looking for diversification because they want maximum growth. Okay, the other problem with emerging markets is that investors are running out of them. Okay, they are normally regionally concentrated, as this pie chart shows. Okay, ETFs tracking emerging markets in general are usually market cap weighted, which leads to a concentration of the largest emerging markets, like China and Brazil. And Asia, for example, is an emerging market, but their stock exchanges are much larger than others in the world, okay, which leads to concentration of almost 50% in Asia alone. So other regions like Latin America, Brazil, and Africa are very much underrepresented. So as you can see by this pie chart, all the money flows to Asian markets, and then the more risk these investors decide to take, because there's very few options in emerging markets anymore. All the money has flowed. And eventually, one of the smallest slices of the pie is Africa, okay, because of political uncertainty. There's a reason for that. So investors are not thinking only of the potential growth, they're looking at where money flows. It's important to understand that. Okay, so when you're investing in any market, whether it's an emerging market or a developed market, these are the risks. I mean, you've got to look at everything. It's political, it's government stability, it's employment. As we always rely on the US employment figures every month. You look at the leadership of that country. You look at their openness to trade. You look at their tax regulations, because you need border crossing. You need to be able to trade with foreign nations. You look at corruption levels, how difficult it is to do business in this country, bureaucracy, and the stability of the countries surrounding you. Now, those are the risks that every investor has to face before he plows his millions and millions into a new market. Okay, now these conditions are taken into account whether it's a developed or an emerging market. Okay, so let's look at the political risk. Okay, and South Africa is not short of any of them. Okay, political decisions by government leaders about taxes or the value of their currency or their trade tariffs and barriers in terms of allowing investment and foreign trade, wage levels, labor laws, environmental regulations, developmental priorities can affect all business conditions, as you guys have seen in the strikes. The platinum strike lasted 5 months. That has a huge detrimental effect on our growth. Okay, so this might, I'm not saying it will, but it might knock us into a recessionary environment. Okay. Similarly, non-economic factors can affect a business. One of our listed companies, for example, a political disruption like terrorism or riots, coups, civil wars, international wars, or even political elections may change the ruling government that can dramatically affect business and their ability to operate. Now, this is not just a risk, again, of South Africa or a developing nation or market. This is a normal threat for any country or any market. One of the big points I want to make is currency risk. And this is the main point. And this is why money flows. It's because investors need to convert dollars to the local currency. That is the international currency. So it does really have a detrimental effect when all of the things that I've mentioned before start coming into play. Because a dollar-based investor needs to convert whatever market he is investing in back into dollars. So that's when he cashes out. And if he doesn't find value or stability in a currency, he's most definitely not going to invest in that country. Volatility. Also, emerging markets tend to be easily affected by the whims of investors. I know as a trader, every single day of my life, I can see how money flows in and out of our market. And when it flows out, it's a problem. And it happens from time to time, especially when we have unrest or strikes or situations of violence. You can see that foreign investment flows out very, very drastically. So we in South Africa are at the whim of the foreign investor. They come and they go very easily. They're like a one-night stand. Okay, so declines in returns is another risk, because as a market or a developing market becomes more liberalized and integrated and more open to foreign investment, the expected return starts to fall. And this is what Warren was saying earlier about Amplat. You know, the market prices things in, and the more potential for growth, the more investment you'll see. But as that potential declines, so will the investment. Okay? So in time, emerging markets come onto an investor's radar. And 10 years ago, no one would have thought Brazil and India would have grown as big as they have. And it would have been highly unlikely for a retail investor like you and me to consider investing in Indonesia or South Africa for that matter. Okay, so you've got to look at the growth prospects and how far to X growth that developing market is. So a developed market is a country that is most developed in terms of its economy and capital market. So the country must be high income, but this also includes openness to foreign ownership, ease of capital movement, and efficiency of a market. Now this is the definition of what a developed market is according to Wikipedia. Now as you can see by this map, there are very few of them. Now an interesting chart that I found was the correlation of investors diversifying into emerging markets versus developed markets. And as you can see, they are so closely correlated. Okay, developed markets start off a higher base and they tend to trend as developed markets trend. So what does this tell you? What this chart is really telling you that investors, especially foreign investors, looking to invest in developing markets, have a lot of their cash at home. And they're trying to diversify, and this is exactly why investing in an emerging market normally tracks whatever the developed markets do. Okay, so to me, this is really a no-brainer. But investing in developed markets needs a cause and a reason, and this is why investors do this. And this is what they look for when they invest. Tactical asset allocation, not as complicated as it sounds. Investors adjust their investment portfolio to accommodate market conditions, and they allocate money to markets which are offering better value and are more likely to perform well in the future. Okay, so what that is saying is they're not looking for stellar performance or high growth or quick money. They're just looking for that market to perform well in the future. That's very important. Okay, diversification. Offshore investing provides investment opportunities that are not available locally. Now that is to an American investor, European investor, or even an African investor. Okay, you need to look elsewhere because you can't have all of your eggs in one basket, even though baskets is all I trade. Okay, but I'm allowed to have more than one basket. Okay, then obviously we've spoken about the currency risk, and sovereign risk is important. South Africa has recently been downgraded, as Warren mentioned earlier, by investment rating agencies on the back of political uncertainty. And our economy is slowing, which raises concerns about our specific country's political risk. Okay, so what are the options for trading offshore? Now, the reason I'm looking at going offshore is specifically based on that chart that I showed you. Emerging markets track developed markets. So when developed markets go down, emerging markets go down. When developed markets go up, we tend to follow more drastically. Okay, so I'd like to be the leader, not the follower. I'd like to be where all the money is, not where some of the money is. Okay, so the safe options are trade from home. You know, so the South African Future Exchange, or SAFEX, has international equity exchange traded funds that track company performance in weighted baskets. And these are rand denominated instruments. Okay, so if you don't mind a little bit of rand volatility or a little bit of rand risk, these instruments are awesome to trade. And as some of my subscribers know, I've been trading the DBX trackers of late because I get exposure and short-term geared exposure to American and European markets at the moment. But these are the things you can trade. You can trade the DBX EU, which is the Euro Stoxx 50. You can trade the UK. You can trade America. You can trade Japan, or you can trade the world. Okay, and this gives you the diversification, and as Runani CEO likes to call it, a staycation, where you can trade offshore but stay at home. Okay, or you can go directly offshore, and by doing this, guys, you're really going to eliminate the rand risk, because then you've converted your money into dollars. You don't have to convert anything else back into dollars again. You know, you're only going to score when you have to bring some of that cash back and have a little bit of a tax problem. So by opening an offshore account in a foreign currency, and particularly in dollars, you're able to trade offshore indices and tracker funds, and thereby eliminating your risk. And that really is the way to go if you're looking for diversification in developed markets. So what are you buying when you go offshore? Now this is just a snapshot of what I looked up the other day, and this is by no means still a performance. If you consider that the JSE has gone up by, I think it's 14% if you include dividends, these developed market stocks haven't shot the lights out. But you know what? None of them are in recession. Okay, so the Dow's gone up by about 3.2%. The S&P, stellar performance relatively speaking, just over 7%. The Nasdaq, almost 7%. And then Europe, a lot more slower growth, but they're still lagging the United States in terms of easing, stimulating the Euro nations. But that is coming, and it's happening, and we've seen this. What I like to see is that they're growing off a very, very low base. It's not like developed markets where they are very highly priced. So you are taking a massive risk by putting all of your money into that, let's say, developing basket. So theoretically, when you're investing in America or Europe, you're investing in the recovery. This is the difference, guys. You're likely to get slow but consistent growth, but it speeds up as those economies start to normalize. When you're investing in an emerging market like ours, you're investing in growth, and you're likely to have rapid growth with high volatility. Now, high volatility is a problem as an investor, because then you need to be able to handle huge swings. You're going to see your portfolio go negative and positive in very short spaces of time. And that is because money flows in and out of them. As things change, foreign investors whip their money out quicker than you can say stop loss. Okay. So this is where my money is, guys. That's my spot on the globe. If you look at the American markets again, the Dow has only grown by 3.24% year to date. The S&P outperformed. NASDAQ very close behind. Guys, this market is already starting to exit that quantitative easing program. They're already discussing moving forward, raising interest rates. To me, this is a sign of growth. The only problem the US has at the moment is they need to get their labor market going, because it's a consumer-driven market. But what I like to see is growth in stocks and earnings. So, here's why I like them. They don't like political uncertainty. I think the US provides a stable enough government, and they're open to trade with the entire world. They don't like corruption. Well, I can't speak for the US government and their corruption level. I can only speak for mine and what I read in the papers. But I'd like to think that I'm rather going to back a government that's in the top 5 of least corrupt governments in the world than rather back one like ours, which is in the top 5 of most corrupt governments in the world. Okay. They don't like red tape. When they're doing business, America has open trade borders. They do business with everyone, including their arch enemies. Okay? And a problem that they don't have is for example, rumblings of nationalization of business, of mining, for example, like we have. Guys are starting to call for nationalizing our mines. The minute that came out, US investors all said, we'll tell you what, you guys can nationalize your mine, but we will take every single dollar out of this country. So you don't need that risk. And then again, these investors invest in regions with more stable economies. Now ours is very far from stable. Okay. One quarter we're growing, the next quarter we're heading for recession. Investors don't like that. And I don't like the volatility. So, let me remind you, a weak currency is evidence of a weak economy, which is evidence of a weak government. But how do we turn bad politics into profit? By buying the complete opposite. Because a strong currency is evidence of a strong economy, which is evidence of a strong government. And that's where your money should be lying. That's the kind of environment we should be backing. Okay, so I'm buying the US recovery. And this is where I think you turn our bad politics into good money. Okay, and it's so easy to do this. Highlighted there is the growth of the S&P 500. Okay, at 7.31%. Now, if you had a geared account, a futures account, for example, you could get access to that growth at probably a multiple, or at gearing of about 9.5 to 10. That means, well, look, if you go high risk, you could probably get 100 times gearing. Okay, but let's say conservatively at 10, you would have made 73% in the last year. And this is not over, guys. That economy has only just started growing, closely followed by Europe. Okay, so what you can do is you can open a dollar-based offshore trading account from as little as $2,500. Okay, then you have the dollars to go and buy the DBX tracker USA. Now the reason I want you to go that route, and I remember the last webinar, this was a stock I punted. These are the 15 biggest holdings, and this is a weighted index. And as companies perform or underperform, they drop out. But there are 600 stocks in this basket. In other words, you are buying American business. You are buying American companies. and every single one of them according to how badly or how well they do. Here's the chart of the DBX US. I think this is as at Wednesday, and I think from the time that I punted it at the last webinar, it's grown by 30%. I think we cashed in very, very early. But the share price itself, and it's starting to come down to test this trend line again. I think it closed around $20 today, 20 Rand today, which is a no-brainer for me, guys. If you're going to buy it, the trend is your friend, as any technical analyst will tell you. But at 20 bucks, you're buying almost every single large cap in America. Pretty similarly, for me, consistency is key. So compared to the chart of the S&P 500, that is what I like to see. I like to see a trend that continues to go up with a dip every now and then to give me a chance to buy. So this is what you need to look out for. When this S&P slightly dips, one more red candle, like every single other time, you need to be able to get into this market. And the only way you're going to do that is with a dollar-based account. However, if you don't have a dollar-based account, the minute you see the S&P dip back to very close above 1900, you need to get that DBX tracker.
Great, Robbie. Thank you very much. I mean, that's very detailed. And I mean, if I can add on there, I mean, just listening to what Kamon said, Kamon was saying you're expecting a weaker rand. I mean, that's another, I mean, you spoke of gearing and using gearing to boost the returns within international markets. Now, as much as 7% in the South African return might not be amazing. Like you said, if you gear it up, you're looking 70%. If you add in a 10% weakness in the rand and you've got a dollar account, that's a massive bonus on your returns. You know? So there really are great opportunities if you're willing to position yourself and just take the time to think about how investors are going to react, and you will know what to do as a trader. So now, guys, feel free. We've got some questions already come through. Put your question up, and if we don't get to your question tonight, we will load them all on the Investors Club and we will answer all of them. So be sure to check that out on the investorsclub.co.za. But if we can move to some of the questions, Robbie, I've got one here for you. I think this one from Andrew. It's a common misperception at the moment. Traditionally, it used to be very difficult if you didn't have tons of money to invest and trade offshore. So Andrew's question is, I've only got an equity account in South Africa. I don't have tons of money. Can I still trade offshore?
Yes, you can. Exactly like the second last slide showed. You can buy any of those DBX trackers from the World Tracker Fund to Japan, to America, to Europe, listed in equity. It is a weighted basket. It is listed. If you have an equity account, you can get exposure to those offshore companies. Absolutely. The stock code for you, Andrew, is DBX and then the nation. So it's either DBX US, DBX EU. But I think we can post this webinar and then you guys can go and look it up.
Yeah.
But yeah, I would suggest you take some of your equity money and maybe open a single stock futures account or a SAFEX account where you can trade the ECFD and try and take some advantage of the gearing. Because if that thing goes up 30 cents, your return is multiplied by 9.5, and you're styling with very little money, you can get a lot of exposure.
Yeah, and I think that's a great opportunity we have here. Is thanks to like new instruments, new technology, it is literally getting easier by the day to trade the world. So no, don't be intimidated by going offshore. Just speak to your broker. He is there to help you. So Timon,
yeah, I see this one. It's actually a very common question I've been getting with regards to Red Hot Storm Trader. That is, hi Tim, when you send out a trade to buy Anglo at 292 at 1106, I'm guessing it's the time, but I wasn't able to get in, and now it's above the price. What should I do when it happens? This can happen very easily, and the thing is, I have a specific level that I want you guys to get in so it reaches a certain risk reward that I follow, that we can reap the most amount of the reward and risk the least amount. So when I tell you to buy a certain level, I mean you must actually put in the order and keep it in there. Don't just leave it. And I will tell you if it gets in, I'll tell you if it doesn't get in, I'll tell you if it hits the take profit before we even get in. I won't include in the portfolio. I do things as legit as I can. So when I set out a trade, put in your levels. I told you, Benoni Private Clients or Global Trader or any other broker, now they are very friendly compared to the past. So you can speak to them, have a conversation, and just say, listen, can you please put my order in at 292 and just keep it in, right? To make sure that they don't close at the end of the day, that it keeps it, and then your trade should be set. You put in your levels and it should be fine. So don't worry if the level's trading above or below. I'll tell you when you're in, and I'll tell you if we didn't get in. But you know what? There are more trades to come, and I'm not going anywhere. So I hope that answers your question, Helen or Helen. Okay.
Yeah, another one. This one I've been asked a couple of times. This time from Vernon. Warren, Capital Wave Trader is holding a lot of positions open right now. Why don't you get into one trade at a time? Vernon, very simple answer with that is I don't control how the market moves, and I can't control when the opportunities present themselves. At the moment, I think we are in quite a strong bull market. You know, the market's very high, and I'm not going to lie, like sometimes my nerves get a bit jittery buying at high levels. But what Robbie told you earlier, go with the trend, go with the flow. And when I see a nice pullback in the markets, that's the time when I want to be buying. That's the time when I want to be getting into trades. I don't want to be buying right at the top, you know, just because I need to have one trade open. Now, if it's a situation I don't see an opportunity, we might have no trades open. At the moment, we've seen a nice pullback over the last few days. I'm happy having a couple of trades open. But what it means is, in any one trade I send out, you shouldn't get too big in that trade. You need to control your size. Remember, we're going to be opening a couple of trades. So you don't want to put your whole account down on one trade. Firstly, it's bad money management. If that trade goes wrong, you're going to lose a lot of money. And secondly, you've got to remember, we want to be able to open between 5, 6, maybe even 8 trades without running out of capital, without having to get a margin call from your broker. So when you trade, rather trade a bit smaller, and remember we're going to have a couple trades open at one time.
Warren, if I can add on to that, you know, you also can't have all of your eggs in one basket, so you need diversification. You can't have, for example, 3 resource stocks open and nothing else.
Yeah.
You need to diversify. And, well, I'm glad that all 3 of FSP services are on the same page. I mean, you are long a couple of resource stocks. Timon, you've gone long a Resi stock, and index traders bought or trying to buy the Satrix Resi at the moment. So that is what's moving the market. But guys, when that changes, Warren's other trades are going to come to fruition because it's very cyclical and sectoral, and that's probably a good thing, not a bad thing.
And can I just add on, you know, when it comes to our trading strategies, we don't see things as too high or too overvalued. I mean, I don't want to put words in Warren's mouth, but the thing is we do have a strategy we follow, and I'll give you an example. If I had in the watch list Berkshire Hathaway, which is now trading at well over $100,000 per share, right? If it formed a formation and it broke out, I'd get in. I wouldn't care if it's overvalued or high. I mean, it actually should, you know, a lesson is there saying that it's at $100,000, and therefore, when is it too high or overvalued in terms of the trading strategy? So, you know, it doesn't really matter in my case with the trading strategy. I don't know how it is with Warren.
Look, I think it's a fair comment. I think maybe we do have slightly different strategies. From my perspective, I wouldn't say I don't believe a share is too high. You know, if it breaks out, I'm not always going to buy it. I think from my point of view, I don't worry too much about the price. I look at the value. And if I can see value in the price where it's trading, I don't mind buying it even if it's at a record high. But if I can't see value at that price, I'm not going to rush into a share.
And from my side as an index trader, I take both of these guys' comments into consideration because I like to see how much influence that share price has on the basket.
Yeah.
So if
there's something running away,
exactly right. So if that share is running and it's moving the entire basket, I'm going to buy the basket.
Yeah. Robbie, just one for you. You mentioned growth prospects are the thing to look at when considering where to invest in the world. Now, you gave quite a long list of different things: political risk, currencies, everything that you need to look. Is there a shortcut that someone can look at, like an economic figure or something? Just a shortcut, any tip that you can give them if they want to get an idea of growth in a region? Is there one thing you can look at, or do you have to look at the whole bunch?
Look, as the slides did show, you know, the problem that investors have is, well, an investor's problem is greed, and that's exactly what rules the market. It's fear and greed, and I think, you know, the purpose of my presentation was not to dissuade investors from investing in South Africa or any emerging market. I'm just saying that you should not have all your money in one place, because one sector will outperform another at some stage or another. So I think the shortcut, if you're going to be looking for something, I think you should be looking at the stability of economic growth and what drives that economy. Now, many economies are consumer driven. Okay, so when the consumer is under pressure, you probably shouldn't be loading up on stock.
Yeah.
Okay, like South Africa, for example, the higher our interest rates go, the more under pressure our consumer is going to be. So maybe hold off a little bit.
Yeah. Especially on like your retailers and that, you can start making calls on where to put your money depending on what's driving that consumption.
Exactly right, and it's all about consumer pressure, guys. So you got to look at where consumers are being assisted.
Sure.
And that's probably where you should be putting the money.
Okay. I've got one here, I see. You said we'll use the CFD on Billiton. I currently trade using single stock futures. Can I keep to them? Because that's what I know. Yes, you can keep trading single stock futures. For those who don't know what single stock futures are, it's another trading instrument, a geared instrument that you can use to trade the shares. It's a standard contract of 100 underlying shares. But my problem is, because it's a standard contract, sometimes you can't manage your risk as you're supposed to. So I have a 2% rule saying you shouldn't risk more than 2% of your portfolio, or those that are a little bit more aggressive, they shouldn't risk more than 5% of their portfolio. But sometimes it's difficult in terms of the calculation when you're dealing with futures contracts, because you're going to be buying a standard contract. And another thing with futures, obviously, is that there's expiry dates and it'll roll over, and then you've got to pay another brokerage leg. But if you are comfortable with single stock futures, stick to them. It'll work just as well. That's the reason why I said CFD on Billiton, because the CFD is a contract of 1-to-1, and so you'll be able to manage your risk a lot easier. So thanks for the question.
Sorry, Timon, that problem's been solved.
All right.
If you have a South African Futures Exchange account, any top 40 stock will have what is now called an eCFD, which is the Johannesburg Stock Exchange traded CFD, as opposed to a normal CFD, which is over the counter. So you don't have to take 100 anymore, guys. You can buy one if you want. The gearing remains the same as per the single stock futures contract, so you're not being ripped off. If you have a smaller account, you can go and buy 1, 10, 15, 21. It's been sorted out. The JSE has come to the party on that.
I'll definitely look into that in the future, and thanks. So you see, just as Robbie's getting more variations or diversification of instruments like BDX-EU and BDX-US, now there's instruments that you can trade that I can build onto our trading services. So it's an ever-evolving process, and it will just keep getting better for you guys. So sure, look it up, ECFD.
Yeah. Rory, just one, also from my personal interest, emerging markets, I'm just interested in your opinion on Russian tensions. Do you see that, we're talking about political instability, and if you're looking for consistency, do you see that consistency, particularly in Europe, being affected by tensions with Russia?
No, I think not at this stage anymore. I think Europe, well, the United Nations has pulled in and said, you know what, guys, this is not on. Like any war or any conflict situation, the market tends, and you've been in the market a long time, the market tends to get bored of stuff like this. And our listeners or viewers need to understand that our world markets are very efficient. It prices stuff in straight away. So the reason that the market fell a month and a half ago by as much as it did was because they priced in the worst case scenario. So the more Russia gets squeezed, I think the better it is for markets, because the market gets bored of news like this, and it's already in the price.
Yeah,
I don't think it will affect your
even
investment.
if the media keep talking about it for weeks now, investors have priced it in, and unless something other than expectation happens, you can expect.
I think you're right. The only surprise now will be a total invasion.
Yeah,
and nobody's going to allow that. Not the rest of the world.
Okay, I think we've got time for one more question, and if I can pose it to Timon. One that's from James. He said, you speaking of getting into Bulletin, when do you anticipate getting into Bulletin if you're calling it going up already?
All right. Well, I'm going to wait for, the thing is, the chart that you saw of Bulletin was on a monthly chart. Now, I don't look at monthly in terms of the trades that I send out to you as per formation. But there is a formation that's forming on the daily chart, and it could be sooner than you think. I can't tell you exactly when to get in. But when it does, it's probably going to be within the next 2-3 months, if I can say so.
Fantastic. Guys, remember, if we didn't get to your question, please, we will post all the questions on the investorsclub.co.za for free, or you can visit there, get your questions answered for free. Someone also emails from Red Hot Trader, Robbie P from Index Trader. Thank you guys very much for joining us this evening. And for myself, Warren Jeffrey, guys, thanks for being part of tonight.
Thanks,
Have
guys.
a great evening.
Thanks.
Cheers.